Okay, so everybody should be looking at this question. This is one of the questions I actually pulled from an older year. I believe this is 2010 or 2011. It's on your paper. I can't see it right now. It is an interesting question, I will say, because you have a lot of different little working to do to make up the 20 marks. But none of the questions are actually difficult questions, but it will require you to think a little bit. And this is why I want you all to try this question. And then when we are going through the questions, you are actually going to be giving me the answers. Okay, so it's not that I'm going to just put up an answer for you all to take down. Okay, so what we have, Cartel V sells leather sandals. His transactions for the month ended July 31st, 2010 were as follows. So we have his opening stock, which is beginning stock. He started off with 110 units at a cost of $55 each. During the period, he purchased 490 units at $70 each. And his sales were 520 units at $100 each. So show all workings for the calculations. Firstly, for 3 marks, they're asking you to calculate the units held as unsold stock. So basically what they're asking you for is what would be the closing stock given this information. So you have to calculate, they're using those figures, then calculate the units of closing stock. They are not asking you for the cost of it, they're only asking you to find how many units. Then they're asking you to calculate the value of the closing stock using the FIFO and LIFO method. So again, you can do this up as a simple statement, but you're not just looking at units now, you're looking at the value. So remember, to find the value, you have to multiply the units by the cost price to give you the value of that, right? You're doing it firstly in the FIFO method, and then second, you're doing it in the LIFO method. I can tell you, this is literally like about 6 lines worth of working to calculate both methods. Then you are going to calculate the gross profit for them. So remember, to calculate gross profit, you need to do a trading account. This is what we were looking at yesterday. A trading account meaning you start off with sales. To find your sales, you are looking at the amount of units they sold and the cost for each. So they sold 520 units at a cost of $100 each. So you can simply work out the sales amount by multiplying 520 by 100 and you will get the sales figure. Then you continue doing your trading account where you're finding your cost of goods sold. And that is opening stock, add purchases, less closing stock. Remember, you will have found your closing stock before. What the figure that you find for your cost of goods sold, now you're going to minus that from your sales, and that will give you your gross profit. Again, it is literally 1, 2, 3, 4, about 6 lines worth of working for that part of the question. And state the main reason why it is necessary to know the stock valuation. Well, you will give a reason. Then calculate the cost price that will be used for the AVCO method in valuing closing stock. We did the AVCO method as well. So you need to figure out what's the average cost. Remember, average cost, you just multiply the units by the price for the different sets of goods, add them together and divide them by the total number of units. So I'm giving you hints. What ratio can be used to calculate how quickly the stock is selling? You did this yesterday, so you should look back and you should find this. And then for part B now, at the end of Cartel V's first year of operation, his accountant presents the following ratios comparing the performance with a competitor. So they're asking you which of the ratios above measure control of cost. Right, so we're looking at current ratio and the expense to sales ratio. So go back in yesterday's work and you will see the different ratios.
Book there, please. Sorry, thank you. Hi.
Hello.
Sorry, Kim, my apologies.
No problem. Sir, are you there? Okay. All right. So as I was saying, we are going to look back in yesterday's handout and try to figure out which ratio we would be using to measure the control of costs, meaning expenses, and which ratio measures the firm's ability to pay its short-term debt, meaning its liabilities. So basically, they give you two hints. And then you're going to do a short report using both ratios to say how Cartel V's is performing when compared to his competitor. So remember yesterday I was saying that whenever we look at ratios, we always have to be comparing them to somebody. So it's either that you are comparing them from one year to the next, but in this case, we are comparing their performance with that of some competitor in the market. So there you have it. That is a full 20-mark question. Nothing here is difficult. It just requires you to think a little bit to figure out the answers. So please try your best. Work on them piece by piece. If you have any questions, you can message the questions or you can put on your mic and you can ask the question and I will help you. But I want everybody to work it out. And for us to correct it, you all are going to be correcting it. You all are going to be going through the answers for me. And what I can do is afterwards, I will probably email out the answers. But I want it to be where you work on these answers, okay? Remember yesterday I was saying to you that one very important thing is we have to start to figure out how to do these questions on our own, because chances are come exams, they're going to bring a question and it is going to be different from what you were doing all along. Okay? The whole point is that if you learn your accounts and you understand the concepts, you understand all the concepts and conventions, you should be able to apply it to any scenario. So that is what I'm trying to do now, is let you all develop that accounting mind so that you can see a question. It might look difficult, but you know what? When you really get into it, it is actually pretty simple to figure it out. So go ahead. Are we done at 20 past 1 already? So go ahead, try your best and work it out. Any questions? Make sure, ask a question. Don't get stuck at any one section and let the time just pass, okay? Try your best to move as quickly as you can. Okay, start working. Is everybody seeing the question clearly? If anyone isn't, let me know. You could even send me a WhatsApp message or an email message and I will send it to you if you didn't access it before. I just emailed out to one student. Remember, if anybody else needs me to email it to them directly, just send me a WhatsApp message and I will email it to you, okay? Remember that you all will be the ones answering these questions, so make sure you have a response. If you have any questions, please ask. So I'm checking in. Are you all getting through? Any questions? You should at least be on part 3 or 4 by now, right? Okay, good, Daniel. Thank you. Yeah, hi guys. Send me a message. Let me know how y'all doing. What number you're at right now. How much time you need again? Maybe 10 minutes again. Or if not, let me know. Okay, guys, are we ready to correct now? How many of you are finished? Or who needs a minute again? If I'm not hearing from anybody, I'll assume we are all finished and we can start correcting. Okay, let's go. First question now. They're asking you to calculate the amount of units held as unsold stock at year end, which, oh, I need about 2 minutes. All right, no problem, Lana, we'll hold on. I'm not hearing from anybody else. Are you all here? Hello, where is the rest of my class? Are you all here? Are you all with me? Okay, good. Thank you, Reagan, Nathan. Anikwa, good. Okay, so remember, I'm calling on you all to actually give me the answers to these questions, right? Hi, Newton. Okay, he's finished. Is everyone else finished? Okay, so I'm gonna go ahead now. So the first question is asking you for unsold stock at the end of the year. So basically, they're asking you to figure out what is the closing stock, right? So would anybody like to give me that answer? You can unmute or you can type in the messenger, anything you want to do, but I need an answer now. Remember, we don't need the value, we need the number of units. $77 from Daniel. Do you all agree with 77? Anybody else? Do you all agree with 77? Hello? Okay, so let's work this out. We want to know how many units we have unsold at the end of the year. So we started off with 110 units. Well, yeah, what the month. Then we purchased 490. So in total, we would have had 490 plus 110. Yes, Anikwa, you're on the right track. So when we purchased the 490, then that means we would have 600. Out of the 600, we sold 520, which means that we would have remained with 80 unsold units. So the answer for the first one is 80 unsold units. Remember, it's the units we're looking for, right? So Daniel, you may have had a little issue probably with your calculator with one of the numbers. So you can check it over and make sure you see how we came up with the 80. Okay, good. So I'm guessing you all don't want to talk on the mic, so I'm seeing everybody messaging instead. That's no problem. I don't like talking on the mic either, but I don't have a choice. But it's okay. You all can message and I will relate the audio. Okay, good. So let's go to the second question now. Calculate the value of closing stock using firstly the FIFO method and secondly the LIFO method. So when we did this in class, we had a long table to basically deal with, but in this question, you really don't have a lot of working to do. So it's just a couple lines to work it out. So anybody who wants to give me the closing stock using the FIFO method, first of all? Closing stock using the FIFO method. You can message or you can unmute your mic and let us know. So 80 units at $55 for LIFO. Well, that's correct for LIFO, good. But what about the FIFO? Right, 80 at 70 for the FIFO. Very good, guys. Okay, so FIFO, I'm going to go through the FIFO method first. So with the FIFO method, we had opening 110 at $55, which would give you a value of $6,050. We purchased 490 at $70. When we sold now the 520, we needed to sell out the first set of goods first. So we sell out the 110 first, and the remainder that we needed, the 410, we take it out of the 490. So that's why we remain with 80 at the value of $70 when you use the FIFO method. And 80 at $70. Now remember, the question asked you to calculate the value of closing stock. So the correct answer for this is not just 80 by 70, is 80 units by $70, which is equal to $5,600. So the correct answer is actually 5,600. That is where the mark will be given, right? Because they want the closing stock. When we deal with the LIFO method now, we would actually take the 520, we will take the goods from the 490 first, and whatever is remaining that we need, then we will go to the 110. So only 30 will come out of the 110. So that means we remain with same 80. But the difference is with the LIFO method, the 80 units are now calculated at a cost of $55. So 80 by $55 will give you a closing stock of $4,400. So you see the big difference there depends on which method you're using. Our answer is off by about $1,200. So it's very important to pay attention to which method is being used. FIFO or LIFO. The rest of you, were you able to get through? I hope you were. If not, take a look back at your question again. I have the answer, but I didn't type it up, so I could probably type it up and send it to you all later. I'm now actually looking, so I'm new to using the program as a facilitator. I used it before as a student, but I'm seeing that I can send a file here to everyone. So I will try that option when I come off of sharing the screen just now, when we finish with this question. Can you repeat the answer for the LIFO, please? Sure. Okay, so when we're dealing with the LIFO part of it, remember LIFO is last in, first out. So the last set of goods to come in, we are taking from there first. So when we sell in the 520 units, we have to take it out of the purchases of 490 first, which means we're selling out the 490 units first. And then we still need 30 units to make up the 520. So that 30 units will come from the opening stock that was there from earlier. So when the 30 units come out of the opening stock, we will only remain with 80 units. But that 80 units we remain with will now be at a cost of $55. So that is why the LIFO answer is 80 units by $55, which will give you a value of $4,400. $4,400. Anybody else needs me to repeat anything? Okay, good. So we can go on now to the next question. Calculate the gross profit for cattle be using the LIFO value for closing stock. So here they're asking you to calculate gross profit. So we have to work out a trading account. The LIFO method for closing stock means that you will use that 4,400 as closing stock in your trading account. So would anybody like to give me the figure for your gross profit? Anybody could just give me the figure and I will explain how the trading account. Okay, so I'm seeing 35,950. You were close, but remember they want the gross profit. What you are giving me there is actually your cost of goods sold. Remember, trading account begins with sales less cost of goods sold. So Nathan, what you worked out is the cost of goods sold. Try from here now and try to come up with your gross profit figure. So that is where you find your sales and you minus this 35,950 from your sales figure. Remember, they gave you sales in the question. They said that your sales was 520 units at a cost of $100 each. So that 520 multiplied by 100 will give you 52,000 for your sales. If your sales figure is 52,000 and your cost of goods sold is 35,950, then simple calculation there to calculate your gross profit, we just minus both of them. Anybody else wants to venture the answer? Anybody? The simple trading account. So this is what I was talking about when I say they will basically test how you can apply yourself to the questions. This is just a straightforward trading account, something that you learn from first term, probably the first month or two we were doing trading accounts. But because of the way the question is structured, it is confusing. But it is not, because essentially if you just put the trading account down and you put in all your figures, you should be able to come up with your answer. So see, nobody is giving me an answer. Okay, so once again, a trading account will begin with sales, and your sales figure will come from where they show you the transaction, sales $100 each, and the units 520, which means to calculate your sales figure, it will be 520 by 100, which will give you sales figure of 52,000. Then to work out your cost of goods sold, it is opening stock, add purchases, less closing stock. If we look at our FIFO method that we were working on before, you can see the opening stock, 6,050. Yes, thank you, Nathan, correct. 6,050 was your opening stock. Purchases were 34,300. And to get that purchases figure, you multiply 490 by 70. And your closing stock, they told you to use the LIFO method to get the value for closing stock. So the closing stock figure we using would be 4,400. You minus your closing stock and you will get your cost of goods sold, which is 35,950. Right? So your sales minus cost of goods sold would give you your gross profit of $16,050. Right? So yes, Nathan, that was correct. The gross profit is $16,050. Anybody else needs me to explain how we come up with that again? Daniel? Okay, so the question starts with calculate the gross profit for cattle V using the LIFO value for closing stock. So they give you the figures, but they didn't give you the figures as values. They give you units and cost price, which means you had to calculate the values that you're using in your trading account. Remember, a typical trading account starts with sales less cost of goods sold to give you gross profit. I can write on my screen. How do I write? So let me see if I can focus. Okay, so I'm stopping the share on the question for a minute. I'm pulling up a whiteboard. Okay, so are you all seeing the whiteboard? Okay, so your trading account. I didn't put in the name and so forth, right? So I'm just typing it up quickly. Your sales figure. To get your sales figure, we would use 520, which was the amount of units, multiplied by the value, which is $100. And that will give you right, so that will give you $5,200. Okay, so after sales, we less cost of goods sold. And to find cost of goods sold, we will start with opening stock. Our opening stock would have been what we started with, which would be our 110 units multiplied by $55. Right, so our opening stock value would be 6,050. Then we add purchases. Our purchases value was 490 multiplied by $70, and that will give you purchases value at 34,300. When you add those two figures together, you will get 4,000 to make it have some semblance. Yes, I am. My mic is on. Yeah. Are you hearing me, Daniel? Okay. Okay, so I'll continue typing up the answer here until Daniel reconnects. Okay, so 34,300. When we add both of them together, we will get a value of 4. Here is someone. Going on with my, all right, 4,350. Okay, good. 4,350 would be there, and then we less closing stock. Our closing stock figure is the figure we calculated using the LIFO method, which would be the 80 units multiplied by 55, which would be equal to 4,400. So when we add purchases and we get the 4,350, we less closing stock, and we put that figure on the end right there, which is the 35,950. Just trying to line up everything a little bit. And finally, to get your gross profit, 52,000 minus your 35,950 will give you the gross profit of $16,050. And that is your answer for your trading account for part 3. So Daniel, is that okay? Do you understand now how we come up with our figures? Okay, great. So I'm going to leave the whiteboard up for 2 minutes again. So if anybody else wants to take down this trading account, go ahead, and then I'll continue with the corrections. Excuse me 1 second. Okay, so I'm going to clear my whiteboard now. And we are going to continue with our question. Okay, so now we are on to part 4. Say the main reason why it is necessary to know the stock valuation method being used by a firm. Does anybody want to give me that answer? Why do you need to know the stock valuation method? Okay, so you realize the big difference we had between the closing stock using the FIFO method and the closing stock using the LIFO method. If you don't know the method that they're using, your values will be very different. So to make sure that you can come up with accurate calculations for your financial figures, you need to be aware of the closing stock method that is being used. Okay, so basically to get accurate stock valuation, you will need to know which method is being used to calculate your closing stock. Right, so that's basically for 1 mark. Part 5, calculate the cost price that will be used for the AVCO method in valuing closing stock. So this question actually tested you a little bit on all the methods of stock valuation. So they want you to calculate the average cost method. So basically, you are going to take the value of your opening stock, the value of your purchases, add them together, and divide by the total value of the total number of units, which in this case would have been 600. So anybody wants to put up that answer for me? Send that on Messenger. Anybody? Somebody? Should I call on people? Newton, are you here?
Hey, Kima.
Hi. Hello?
You did something?
No, I'm calling on a student. Yeah.
Oh, I thought you said, Linda, are you here?
Oh, no, sorry, no. Okay. Newton, are you here? Reagan? I'm seeing people in the chat, but Nathan, you want to venture an answer? Musa? Anybody? Is it that you all were not aware how to calculate the closing stock using this method? You can let me know that if you weren't able to come up with an answer. Would you like me to do it on the whiteboard again, just like how we did the other question? Okay, I'll take silence as consent. Yes, okay, no problem. All right, so I'll stop this share and then I will go back to a whiteboard. Okay, so we need text. Okay, to get the average cost, we need to get the amount of units we have. So first we had the 110 units at the value of $55. So that will give you a total value of 6,050, sorry. Then we have the 490 units by a cost of $70. So what I'm doing here is I'm getting the value of all the goods that we had to the 300 right? So then we need to add both of them together. Who has their speaker on? Can you mute, please? Unless you have a question. 40350. So we get the total value there. That 40,350 is the total value of the opening stock as well as the purchases. So what we need to do now to get the average cost value is we need to take that total value and divide it by the total number of units. So we are going to add the 110 and the 490, which is 600. And when we divide it, we will get the average cost value of $67.25. Right? So that is how you calculate your average cost value. So go ahead and take it down. Okay, so I'm going to clear this now. And I'm going to go back to the question. Okay, so the next part of the question, what ratio can be calculated to measure how quickly Cartel V sells his stock? So basically we want to know how quickly he turns over his stock. So the ratio we would use there would be what we learned about yesterday, the stock turnover ratio, right? So simple question, they didn't even ask you for the formula. They just want to know which one you would use. So the stock turnover ratio. And we go down to part B now. Part B, at the end of Cartel V's first year of operation, his accountant presents the following ratios, comparing the performance of Cartel V with a competitor. So we have the current ratio, and we have the expense to sales ratio. So they want to know which of the ratios above measures control of cost. So of course, to be able to tell that, you need to know what is the ratio, right? So I'm hoping you all check the current ratio and check the formula for the expense ratio. Which one you think out of the two of them are used to measure how you would control your cost? I want an answer for this one, okay? Anybody? Remember, we're learning, so you can go ahead and venture an answer. Anybody at all? This wasn't any calculation. What do you think? Nobody has an answer? So current ratio is looking at how well the business is able to pay its current liabilities. So we're looking at current assets over current liabilities for current ratio. When we look at expense to sales, we are comparing our expenses to our sales, and to get the percentage, we just multiply by 100. So expenses over sales by 100. So if we want to know the ratio to control cost, the one that is dealing with cost is obviously the expense to sales ratio, because expenses are the cost that the firm is going to incur. And then they ask you for the ratio that measures the firm's ability to meet its short-term debt, meaning current liabilities. So which firm deals with the current liabilities? The current ratio is current assets over current liabilities. So obviously the answer for 1 is expense to sales ratio. The answer for 2 would be your current ratio. So again, this question did not ask you to state the formula, but in other questions, they may ask for the formula. So make sure you are familiar with the formulas. As I said before, the first one, current asset over current liability. The second one, and the answer that you get when you put your current asset over your current liability is a ratio. So we are putting a 2-1. So you realize in both Cartel V and the competitor, Cartel V is 12.5 to 1. The competitor is 9 to 1. Whenever you're working out a ratio, make sure you put your answer to 1. And the last part of the question, prepare a short report using both ratios, comparing Cartel V's performance with that of the competitor. So when we're dealing with the current ratio, any current ratio of 1.5 or above is considered healthy. If you get a current ratio below 1, then that means that the company is struggling. So both of them have high current ratios. So both firms are able to meet their short-term debt very well, actually. Cartel V is able to meet their short-term debt actually a little bit better than their competitor. So Cartel V is in a very good position. When it comes to the expense to sales ratio, Cartel V is 28% and the competitor is 33%. So the competitor actually has higher expenses. And the aim of most firms is to keep expenses low. But of course, you will have expenses. So when you compare both of them and both ratios, you would realize that Cartel V is actually doing better than the competitors when we look at both the current ratio and the expense to sales ratio. So Cartel V is actually performing better, right? And that ends this first question. And that brings us to 20 to 3. So it took a long time to work through this question, right? But I'm happy that you all, as far as I could see, the few of you were able to actually get through with certain parts of the answer on your own, because this is what it is about. You have to be able to take what you know and apply it to whatever question they bring for you, and however they choose to phrase that question, you need to make sure and have the ability to come up with the answer. Okay, so of course you can take a break now. It is 20 to 3. So you can take a 15 minutes break. So that will bring us back to 5 to 3. So basically we will start back. I will stop sharing the screen now. When we start back at 5 to 3, I'm going to try to send the files to everybody that we're going to be looking at after, right? So go ahead and take a break, get something to drink, have a snack, and I'll see you back here in 15 minutes. Right, so as we know, depreciation is a wear and tear on assets. An asset is anything that the company owns for a long period of time. Now, when you own an asset, the value of the asset will never remain the same, meaning if you purchase it for 100,000, over the years, it will not be worth 100,000 again, the value will fall. And what the companies try to do is they try to assign part of that cost to all the different years that they own the item, so that at the end, they don't have to go through a significant cost reduction of it. So let's say it is a vehicle. The vehicle would be valued, let's say $100,000. What they will do the first year they own the vehicle, that value will fall. Right, the value of the vehicle will fall. So let's say they assign $20,000 to the depreciation. So at the end of that year, the value of the vehicle would be $80,000. The next year, they might assign another $20,000, and so forth and so forth. So basically, at the end of 5 years, this vehicle will not be worth anything. And that is how they will spread out their depreciation. So they know after a certain period of time, they have to acquire a new vehicle. Sometimes they will have a value they will assign for it. So at the end of the time period, what they could do is sell off the vehicle and recover some of the costs that they paid for it, right? But it all depends on their decisions, how they decide to treat depreciation in their firm. And of course, your questions will tell you as such what to do with their depreciation. So it is an expense and it must be charged as all expenses to the profit and loss account. So this morning we looked at the trading account where we were able to calculate your gross profit. In the profit and loss part of it, we go from gross profit, we put all our expenses, add them up, minus it from the gross profit to come up with your net profit, right? So our depreciation expense is an expense that will go in that list as well. The causes of depreciation. So physical wear and tear, basically physical deterioration. You're using the item, it will obviously lose value. As it is being used, it will be depleted. Economic factors in terms of after a certain amount of years, certain equipment or certain things they use in the company will become obsolete or inadequate, meaning technology is changing so much every single day. Simple example, look at us. Every week we are having class in a classroom. I'm there face to face with you all, and today and yesterday I am talking to you all over a device, and we are still having class. So over time, another factor, over time things change, technology change. So of course, the value of an item will never remain the same. It will deplete. So we have different methods of depreciation, and you all know this one already, right? We have two main methods that are used. We have the straight line method and we have the reduce and balance method. All right, now, are there any other ways of calculating depreciation aside from the reduce and method and the straight line? I believe there is another method, but you all don't have to do that method at your level. That will be if you go on to study accounting at a higher level. There is another method. But for now, we are dealing with the straight line and the reduce and balance. The thing though is that even though we are learning to calculate the reduce and balance and the straight line method, most of your questions wouldn't even require you to use these formulas to calculate, as you've seen before in your questions, where they'll just give you a percentages and say calculate your depreciation on the vehicle 20% or 10%. You have to do what is said in the question and you have to follow the guidelines of your question. But it could come in a question as well where they might ask you about this formula. So you still need to have an idea what the formula is. Okay, so we have the straight line method, which involves the cost price of the asset. We look at the estimated year that is going to be in use and the expected disposal value. The depreciation charge each year can be calculated as follows. So we have a formula here we need to look at. Depreciation charge per year, cost price, meaning if we bought the item at 100,000, how much we expect to get when we when we sell it off. So we bought it at 100,000. We expect to sell it at the end of its usefulness at 10,000. So it'll be 100,000 minus 10,000 will give you 90,000, and then we divide it by the number of years in use. So let's, for easy calculation, let's say we're going to keep it for 9 years. 90,000 over 9 years will give you 10,000 a year. So the charge using the straight line method means that we're charging 10,000 per year for depreciation expense. So we have an example here. For instance, a car was bought for 22,000 and the business decided to keep it for 4 years, then sell it for 2,000. The depreciation to charge would be the 22,000, which is the cost, minus the disposal value, which is the 2,000. So we will get 20,000 divided by 4, which gives you 5,000 each year for your depreciation cost. Again, I'm going to say to you, remember that you have to pay attention to whatever your question is telling you, because the majority of questions in accounting exams do not give you all this to calculate. The only time you really get these kind of calculations to do is when you're doing the little exercises that you might see in your accounting text. But in your questions in the exam, the majority of the time, they will say, charge depreciation on an item at 10% or at this percent. What is important to note, however, is whether this is straight line or reducing balance, so you will know if you have to reduce the cost. So let me just continue here. If after 4 years the car had no disposal value, then the charge for depreciation would be the cost price 22,000 over the number of years, which will give you 5,500 for depreciation each year. The reducing balance method now. So the reducing balance is referred to as fixed installment method, but they will usually say reducing balance. Depreciation to be charged involves deciding on a percentage amount to be used each year. The percentage is then deducted from the cost price of the first year and in subsequent years from the reducing balance. Reducing balance meaning every year you have to draw down on that cost of the item. So example, if a machine is bought at $10,000, depreciation to be charged at 20%. Calculation for the first 3 years would be as follows. We find 20%, which in this case we have 2,000. We minus the 2,000 from the 10,000, and we get the reduced balance of 8,000. So after the first year, the new balance of the item of the machine is 8,000. In the second year now, we have to find 20% again, but we're not going to find 20% of the 10,000. We are going to find the 20% of the reduced balance. So the 20% will be of $8,000. 20% of $8,000, $1,600. Next year now, the third year, we reduce the value again. So we minus the 1,600 from the 8,000, and we get a reduced balance of 6,400. Again, we find the 20% of the 6,400, which is 1,280. So the net book value, meaning the value of the machine after the 3 years, taking into consideration depreciation, will now be 5,120. So usually in questions, they will tell you a percentage, but they can tell you if they use the straight line method or the reducing balance method, meaning, do you need to reduce the balance every time to calculate back that percentage? Or if you're using straight line method, you use the percentage, but you use that for all 3 years. So I'm going to repeat that one more time. Usually with our questions, they will tell you a percentage. They will also tell you whether it is being charged reducing balance or straight line method. But you have to know, well, if it is straight line method, we use that whatever we calculate as a percentage, we minus in that same amount every year. If it is reducing balance, we find the percentage, we minus that cost from it, the new value of it, we find the new percentage, minus the cost, and so forth over the years. But usually they will just give you 1 year, 2 years for the most to deal with. But you've been dealing with depreciation in questions for a while now, right? But this is just in case it comes up in any new questions in terms of how to record your depreciation. Right, so it's an example here. So you will get this handout to look at as well. In this example, basically they're telling you to work out, you bought a machine for 8,000, you're working out the depreciation using both the straight line method and the reducing balance method, right? So this is an example you can go through. All the working is there already. But what I want to pay attention to is the actual recording depreciation. Because so far, as I said, we've only dealt with depreciation in terms of for your financial statements. We have not done any actual T accounting with the depreciation. So your T accounting with depreciation, it is laid out here nicely in terms of what are the different steps to record it. So the fixed asset accounts show the assets at cost price, whilst the depreciation is shown separately, accumulating in a provision for depreciation account, which means when we buy a machine, we purchase the machine for a cost. The normal double entry for that will be to debit the machinery account and credit the cash account, because that if we paid for it cash, we credit cash account, right? That is normal, that will stay that way, right? So the example is, say the business purchases a machinery for use in the business workshop for 2,000 on the 1st of January. The company uses the reducing balance method of depreciation using a rate of 20% per annum, and again per annum means per year, and the financial year ends at 31st December. The accounting records for the first 3 years are illustrated below. Okay, so the first thing we do when we purchase the machinery, we purchase it on the 1st of January and paid for by check. So we will debit the machinery account and we will credit the bank account, because remember the money is coming out of the bank account, right? That this should be familiar to you all. Number 2, at the end of the financial year, the asset is depreciated at 20% per annum using the reducing balance method. First of all, we need to calculate the amount of depreciation to be charged each year. So the cost of the machinery was 2,000. In the first year, 20% of 2,000, we have $400. So the reduced balance now, when we minus 400 from 2,000, will be $1,600. So in year 2 now, we need to calculate 20% of the $1,600, which will be $320. We minus the $320 from the $1,600. So for year 3, we calculate 20% of the now $1,280. So they mix up the figures there, right? So that's $1,280. 20% of $1,280 is $256. So we minus the $256. At the end of it now, the end of the 3 years, we will remain with a value of $1,024. So that would have been how to calculate the 3 years depreciation. But here is the actual recording that depreciation. Okay, so net book value equals the cost price, which is 2,000, minus the total depreciation. The total depreciation, of course, would be the total of all 3 years added together to give you that net book value of 1024 at the end. To record the depreciation, we are going to debit the profit and loss account with the amount of the depreciation each year and credit the provision for depreciation machinery account with the amount of depreciation each year. So if we look here now, we would see okay, trying to center. All right. When we buy our machine, we bought it for 2,000. We debit the machinery account and we credit the bank account because the money is coming out of the bank account. That machinery that entry, that 2,000, will remain 2,000, okay? Because that is the cost when we purchase the item. So 2007, January 1st, we have the cost bank 2,000. December 31st now, we want to balance off the accounts. So we need to carry down 2,000 on the credit side so that the machinery account balances off 2,000 for that 2007 year. We seen that, everybody? Now, when we carry down a balance, we know that we have to bring it forward into the next year. So 2008, January 1st, we have balance brought down. The same machinery, $2,000. And the same thing goes on the end of 2008. We need to carry down the balance to 2,000 and then bring it forward into 2009. And again, 2009 at the end, we carry it down and then we bring it forward into 2010. So you realize the value on that machinery account is not changing. Okay, the value is not changing, but we need to make sure and put in all the entries to show that we started off with this amount. By the end of the year, we still had this amount, so we carried forward to the next year. The end of that year, we still had this amount, so we carried forward to the next year and so forth. Because for proper accounting entries, this is how it needs to be done. Because at the end of 2007, we couldn't just put a double line under the bank account there and end it there, because then that would mean the machinery disappear when 2008 come 2009. So that's the whole purpose of carrying down the balance, bringing it forward to the next year. Carry it down, bring it forward into the next year. So this machinery account should be pretty simple. Okay, any questions on it? Any questions? Any questions so far? Okay, so the cash book entry, in the cash book, of course, okay. We have the entry showing that, hold on. We have the entry showing that there was a credit entry for cash. Okay, thank you, Newton. All right, there was a credit entry for the cash book to show that the money came out of the cash book of the bank account and went to pay for the machinery. Okay, the provision for depreciation account now, this is what we're looking at. Remember, we already calculated the cost for depreciation before, right? Year 1 was 400, year 2 was 320, year 4 I think was 256, right? The thing now though is the actual accounting for it. We have to open a provision for depreciation machinery account. Your provision for depreciation machinery account, we are going to make a credit entry because that 400 that we are going to put in, that is going to the profit and loss account. So the debit will be in the profit and loss account. So you remember, we start with a credit entry in the provision for depreciation account. So December 31st, profit and loss account, $400. That is the first year charge of depreciation. At the end, December 31st, remember, we have to balance our accounts. We are going to carry down that balance. So on the other side now, on the debit side, we will see the December 31st balance carry down 400. Now, ideally, we are supposed to put the balance underneath in the next line, that 400 and 400 on the debit and credit side, and then put the double lines, right? When it is carried down in December, of course, it is brought forward into the next year. So January 1st, 2008, we bring forward the $400. On the credit side there, we seen that. And then now we have to add, at the end of the year, the charge for 2008. 2008, we worked out our depreciation before to be $320. That $320 will be charged to the profit and loss account. So if we were doing up that trading and profit and loss account, one of the expenses would be provision for depreciation, $320 in 2008, we're talking about, right? At the end of 2008 now, we have to add up the two entries to get the total. So we add the 400 to the 320 to give us 720. Now we need to balance the account. To balance the account means we need to input 720 on the debit side. So we'll do balance carry down on the debit side, 720. And then we bring down the 720 and put the double line so that it is showing on the same line across from each other, the 720 with the double line under it. That means that that account was closed off for 2008. Go forward now to 2009. The balance carried down of 720 will be brought down in 2009. So balance brought down 720. And then at the end of 2009, we will charge again the amount to the profit and loss account, $256. When we charge that to the profit and loss account now, we need to balance the account at the end of the year. So we get the total, 976. We do a balance carry down on the debit side, 976. So we do the total 976 on both sides and we do a double line. And we closed off at the end of 2009. And of course, 2010, we do a balance brought down for 2010, $976. Right, so the main thing to remember with the provision for depreciation account, you start off with a credit entry because the debit is done in the profit and loss account. Right, so the only account that is really being affected here is your profit and loss account. So the only details you should have is your profit and loss account. Other than that, the other entries are just the balancing entries, which is the balance carried down, balance brought forward. Any questions on this one? Okay, good. So what I would suggest is that you take the same example and you can actually try to work out the accounts after, right? Just to make sure that you truly understood what we went through. All right, so if you had to show now the profit and loss and the balance sheet extract, right? Sometimes questions will call for this, right? They want to see the extract, which means they don't want to see an entire profit and loss account. They just want to see what you charged it. This is how you would show it, right? The profit and loss extract. So for 2007, depreciation, $400. Well, ideally that should have been provision for depreciation because that is the account that was affected above, right? 400. 2008, the provision for depreciation was 320, and 2009 provision for depreciation was 256. If we look at the balance sheet extract, now in the balance sheet, remember when we are dealing with depreciation, we usually do fixed asset. We will name the fixed asset. So we have machinery. We will have a column for cost, total depreciation, and then the net book value. All right, so in 2007, the cost was 2,000. The total depreciation in 2007 was just 400. The net book value, we minus the 2 and we get the net book value of 1,600. That's done there. 2008 now. Cost was still 2,000. Remember that cost did not change in the machinery account. The total depreciation, however, at the end of 2008, if we look at our provision for depreciation account, was 720. We minus the 720 from the 2,000 and we will get the net book value of 1,280. The 1,280 is what the machine was worth at the end of 2008. 2009 now, we have the same cost because again, the machinery cost did not change at any point in time and cannot change actually. The cost of it was 2,000. The total depreciation now for the 3 years was the 976, and we would see that from the provision of depreciation account from above. The net book value when we minus the 2 would be 1024. So this is how we end up with the value at the end of 3 years as 1024. So basically this was to show you how to do your entries, to record your entries for depreciation. Right, another example is another example here. Right, this is of a business with financial years ending the 30th of June. The motor car is bought on the 1st of July for 8,000. Another car is bought for 11,000. Each car is expected to be in use for 5 years, and disposal value of the first car is expected to be 500, second car 1,000. We are using straight line method. The first 2 years accounts are shown below, right? So depreciation per year using the straight line method. So we have two cars, right? We have car number 1 bought in 2007 for 8,000. So the cost price would be 8,000. The disposal value they said was 500. So we have to minus that 500 from the 8,000 and then divide by the 5 years, which is the total useful years for it. And we'll get 1,500 depreciation charge per year. For the second one, the cost price was 11,000, but the disposal value was 1,000. So 11 minus 1, and then we divide by the number of years, 5, to give $2,000 depreciation charge per year. All right, so again, we have the entries shown here. The motor car was bought. We have to show when it was bought. So the 1st of July 2007, we buy the first car, $8,000 debit in the motor car account, and of course there'll be a credit in the bank account. They didn't show you that here, but there's a credit in the bank account. At the end of 2007, we would have had to carry down the balance. So they didn't show you where to carry it down and bring it forward. Well, that 8,000. Okay, so they mix up the years there, right? So that should have been 2007. They carry it down 8,000 and then they bring it down 8,000 in 2008 on the debit side. In 2008, we buy another vehicle, this time $11,000. So we have the balance brought down from 2007 plus the new vehicle, bank 11,000. So the new balance carried down in 2008, you see the mix of the years. So the new balance carried down in 2008 was 19,000. And that again is brought forward now into 2009. So we have $19,000 worth in motor vehicles. The provision for depreciation. In 2008, we had to charge $1,500 for depreciation. Oh, sorry. The reason why I'm saying there's a mix-up is not because the years mixed up, it's just because they started at half of the year. So it went from July to June the next year. Right, okay. So the provision for depreciation. So June 30th, we had the balance carried down 1,500 and it was brought forward July 1st, 1,500 in 2009. Yes, in 2009, it was brought forward 1,500. And in 2009, we would have had to charge 2,000. Okay, they worked out the depreciation for 2,000. Okay, so in 2009, when they worked out the depreciation for 2,000 for the second vehicle, the total charge for provision for depreciation was 3,500. So the 2,000 plus the 1,500. I don't like this how this example worked out though, because it is two different vehicles. So we should treat them separately. You should treat the depreciation separately. But they put it together as in the 1,500 and the 2,000 added together, the 3,500. So the profit and loss account for the year, they had the depreciation in 2008 at the 1,500 and in 2009 depreciation at the 3,500. Motor cars. Right? Yeah, they just treat them together. Because the same thing with the balance sheet and the in 2000, well, the first balance sheet 2008, they give you the cost 8,000 minus the 1,500, the net book value 6,500. In 2009, the cost 19,000, so that the total cost of the two vehicles, the total depreciation in 2009 would have been 35. How much did they work out for their depreciation? It's 2,000. Okay, this example kind of very mixed up because the depreciation charge for the second vehicle is 2,000, but the charge it at 3,500 and then at the 1,500. So we won't bother with this example. Don't worry with the second example. They made some mistakes with their figures over there. But in terms of your entries, go with the first example. Yeah, go with the first example. There's an error there. All right, well, the last thing here we're dealing with is to dispose of an asset. So we know when we buy the asset, we are going to debit the asset account and we are going to credit the bank account. We debit the asset account, we credit the bank account. Now we are going to look at when we are ready to sell the asset. So upon the sale of an asset, we will want to delete it from our records. This means that the cost of that asset needs to be taken out of the asset account. In addition, depreciation of the asset that has been sold will have to be taken out of depreciation. Profit and loss on sale, if any, will have to be calculated. When we charge depreciation on a fixed asset, we'll have to make estimates. We cannot be absolutely certain how long we will keep the asset in use, nor can we be certain at the date of purchase or how much the asset will be sold for. So basically, depreciation is a provision. Depreciation is not an actual expense, meaning we don't actually physically take out cash and pay to depreciation, right? That's a concept that when you're doing accounting at a higher level, you would have to be very mindful of. Depreciation is not an actual cash expense. It is just charged to make account for the fallen value of an asset. So I don't want to say it is guessing, so basically it's just estimating. So when it is we decide now we're going to sell off or dispose of an asset, we have to do certain accounting entries. For instance, on the sale of a fixed asset, the following entries are needed. We need to transfer the cost of the asset to an assets disposal account. So if we're going to sell a machine, we have to take it out of the machinery account. Now remember, when we buy the machine, we would have debited the machinery account and credited the bank account. So it's a debit in the machinery account. So if we want to take it out, we need to credit the machinery account and put it into the machinery disposal account. So we have a debit in the machinery disposal account. Then we need to transfer the depreciation charge to the assets disposal account. So we are going to take it out. We're going to debit the provision for depreciation. Remember, the provision for depreciation we would have usually credited, but we're taking it out now. So we're doing the opposite. We're crediting it. And then we are going to we are debiting the provision and we are crediting the machinery disposal account. Okay, for remittance received on disposal, meaning when you sell the machine, you will receive money for the sale. When we receive money, we will debit our cash book and we will credit the machinery disposal account. If there's a difference in the amount, we will transfer the difference, the amount, to balance the machinery account to the profit and loss account. Of course, if you made a profit, if the machinery disposal account shows a difference on the debit side of the account, there's a profit. And a profit will be added to the profit figure in your profit and loss. If it is the machinery disposal shows a difference on the credit side, then it is a loss. And the loss will be shown as a debit, it will be shown as an expense in your profit and loss. So a profit will be added to your income, but a loss will be shown as an expense. Okay, so basically what we just went through there, this is your example here. Hold on. Yes. So with the profit and loss, okay, well, here what? I'm going to go through this example so you'll see it. You will see the actual debit and credit, right? Okay. So in this example now, they are saying if the machinery already, all right, the records at 31st December show the cost of the machine was 2,000, total of 976 had been written as depreciation, leaving the net book value as 1024. So that was before the first example we were looking at. If therefore the machine is sold on 2nd January for more than 1024, a profit on sale will be made. If, on the other hand, the machine is sold for less than 1024, then a loss on disposal is incurred. So that's basically pretty straightforward there, right? So the actual accounting for it. So we have the machinery account. The machinery account would have been debited when we buy the machine, but we want to take it out of the machinery account and we want to send it to the machine disposal account. So that is why we have the entry on the credit side for machinery disposal, 2,000. So we're taking out that machine from this account and putting it into the machinery disposal account. So if you follow it, we're going from the first account there to the third account, you see the machinery disposal account. And on the debit side, we have machinery, $2,000. So now we're dealing with this machinery disposal. Then we have the provision for depreciation machinery. We have the balance on, well, basically all the depreciation, the balance brought down 976. We want to take out that 976 now. So that's why we have a debit machinery disposal 976. We debit that provision for depreciation account. So we're taking it out of there and we're putting it into the disposal account. The disposal account now, we should see provision for depreciation 976. That's entry number 2 there, right? Now, the cash is how much they sold the machine for. They sold the machine for $1,070. We received that cash, so we'll debit the cash account and we'll credit the machine disposal account. So we're seeing it credited here. That cash now of $1,070. Now what we need to do is we need to balance the machinery disposal account. To balance it now, on one side, we ignoring this December 31st profit and loss right now, right? We're looking at the 2,000. On the credit side, we have a total of 2,046. So we need to put an entry to balance it off. So December 31st profit and loss, $46. That $46 now is a debit here in the machinery disposal, which means it will be credited to your profit and loss account. If it is credited to your profit and loss account, that means it is a profit being added on. If it was debited, if the December 31st profit and loss, if that was actually on the credit side in the machinery disposal, it would have been debited, which means it would have been a loss. So look at it here again. Machinery disposal, when we balancing off the account now, we needed $46 extra on the debit side of the machinery disposal account. That $46 extra is being transferred to your profit and loss account. When it is transferred to your profit and loss account, it will be credited to your profit and loss account. Credited meaning added to your profit and loss, right? So we add profit of sale of machinery, $46 to whatever your gross profit was. Is that a little bit clearer in terms of whether you make a profit or loss? Yes, okay, good. Right, but now this is, again, it's just a formality to cover these things. We need to understand the debits and credits, but they really, so I'm not saying that they never, I'm saying they really bring where you need to actually do all the entries, right? The most they might ask is for the extract from the profit and loss or the extract from your balance sheet, but you still need to understand the actual debits and credit. All right, so they basically show you now the difference. If it was sold actually at a loss, meaning they sell it for $950 instead, you would have actually made a loss, right? So the machinery account, so we do the same thing. We take it out of the machinery, we put it into the disposal, we take out the depreciation, we put it into the disposal account. But now we need to balance it, and we need the balancing figure on the credit side of the disposal account. That credit entry in the disposal account means that they made a loss of $74. So that credit entry in the machinery disposal is actually going to be debited in your profit and loss. And a debit in the profit and loss means that it is an expense. So it is a loss being incurred here, right? So this is just the other side of it, right? So as I said, we will ignore this second, the second exhibit, because they mixed up their numbers here in the second exhibit. So take that one off. Right, they mixed up the numbers there. Everything else should be okay here. All right. So this will just cover this small topic. In the case that it might come in some form or fashion, we need to be aware of how you actually do your entries. Depreciation. Okay, so you should have the document that you are doing your question. All right, the first question, we completed it already. Your second question, Jan 2013, is an old question, but it's still very relevant. You have to do some work on ratios, as well as you have to do a FIFO method of valuation. And the Jan 2012 question is a depreciation question, a full 20-mark depreciation question, but it still is not asking you to do the double entry. It is asking you to do the calculations and show them in a table, right? So what you will do is you will complete these two questions and email them to me, please, to check. You have the questions from yesterday to complete an email for me for next week Thursday's class. So these two questions you will email for me for next week Friday's class. Because remember, we'll be having another makeup session next week Friday from 1 to 4 p.m. Are we all clear with what we need to do? So again, Mr. Lyndon should have sent this out to you. Your handout would have the example that I just took out from mine, so I wouldn't send it back. Just delete that second example from your handout. Don't go through that because it will confuse you with the mix up in figures. All right, so remember, you finished the first question. So the two sets of questions I sent on the 2 days, basically we completed one of the questions, and the two other questions you have to complete and send to me. So I expect you all to please complete them and email them to me, or send them in on WhatsApp even if you want, and I will check it for you. Okay, remember, the only way that we can get this properly is you have to keep practicing the accounts. Even if they decide to push forward your exam, right? There wasn't any actual word on the CSEC exam as yet, from what I know. But even if it gets pushed forward, you are still preparing for exam. So please, even if it is just a half an hour every day, try to work on some of your questions, because as I explained yesterday, as I showed you all yesterday with Shalanda, who was like completely lost in accounting for the first term and part of this term even, and was able to get 82% in the midterm exams. That should show everybody that it is more than possible if you actually apply yourself and you actually keep working on your accounts, you keep practicing your accounts. I am available if you have any questions. You can WhatsApp me or email me. I'm not checking my email often anymore, so but I will check at least once for the day, so you have a better chance to get me on WhatsApp. Feel free. Remember the resources, we are here to help you, but you need to actually put in the work as well. Do you have any questions on what we would have completed today? Any questions? Anybody? No, miss. Thank you. Now, I understand you all don't like to put on your mics to talk, but I appreciate if you still send a little message in the messenger so that I don't feel like I'm just sitting here talking to myself. Okay, this whole thing is so new to me as well, right? So, if you all could communicate with me, it would be very much appreciated. So I'm gonna go ahead and end off today's lesson. Feel free to message if you need to. And please work on your questions and send it to me. Be safe. Try to follow all precautions. But will there be Friday classes? No. Friday classes will only be for next week now. So this week and next week, so that makes up for the 2 sessions that we missed in March. Right? I don't think we will need to take more classes going forward. So as long as you are practicing your work, honestly, that is what needs to be done now. Right? So next week we will have class Thursday 9 to 12 and Friday 1 to 4. But after that, we will just go back to Thursday mornings only. Good? Okay, good. So if there's nothing further, I will end off today's session. As I said, be safe, everybody. And I'll see you all next week, Thursday. Take care.